So good morning, welcome everyone to our webinar, which is on problem property to do with distressed property and lending. So thank you for joining us. My name is Alex Pelopoulos. I'm a finance partner at New Manor Law, which is a specialist real estate finance firm based in the City of London. So before we start, a few housekeeping points to get out of the way first. The webinar is being recorded and the plan is to close as close as possible to the end of the hour, which is 10 o'clock. There's a couple of ways we'd like to make this interactive and involve you in our discussion. Firstly, there are a number of polls that we will take at intervals, and I'll pause the discussion with the panel at those points for these polls to pop up for you to respond to. And secondly, you should see that there's a Q&A function at the bottom of your screen for you to type any questions that you'd like to put to the panel as we go along. My colleague James Dakin, who you can see on the screen there, will operate as the roving mic and gather those questions to put to the panel at appropriate points. So when we began planning this webinar back in July, we could all see the economic headwinds were growing with inflation, energy costs, and discussions had begun about how far the Bank of England would put up interest rates. And this was set against the backdrop of a pending change in government leadership. So fast forward to today, and to say things are in a state of flux is an understatement. Those headwinds are even stronger. We're still reeling from the impact of this so-called mini budget, and many have hit the pause button understandably whilst we try and get more clarity from the government regarding its fiscal plans. Meanwhile, the same issues ultimately persist: inflation, interest rates, shortage of labour, the energy costs, etc. And so there's a real sense, though, that we are at a potential tipping point. However, the purpose of our talk today is not all doom and gloom, but to discuss these issues and understand how we get through them as the property sector, and also uncover the opportunities that will arise. So to help us make sense of this all, I'm very pleased to say I'm joined by my knowledgeable and experienced panel, whom I'll introduce one by one, and then I'll allow them to say a little bit about themselves. So let's start with you, Tom, from Voltaire. Can you introduce yourself, please?
Hi, everybody. I'm Tom Brown. I'm a partner at Voltaire Financial. Voltaire specialise in raising debt and equity on behalf of investors and developers.
Thank you, Tom. And Fergus, can you introduce yourself, please?
My name is Fergus Jack. I'm a partner at CBD Urban. We're a niche investment and workout practice focused on investment sales of retail and residential assets, and then workout of all asset classes. And we also provide property-related workout services to administrators and IPs in general to help them through their real estate journey, acting as managing agents sometimes, but mainly asset manager to get them to the perfect solution.
Right, thank you, Fergus. And then one of our two partners, I'm pleased to say we got from FRP, Avinda. Can you introduce yourself, please?
Morning, I'm a partner at FRP. FRP has a number of solutions, including restructuring, corporate finance, particularly, I suppose, important at this time with all the changes happening in the economy.
Right, and last but not least, Phil, can you introduce yourself?
Good morning, everyone. So I'm Phil Reynolds. I'm a restructuring partner in our London office. So we thought between myself and Avinda, we can kind of cover both kind of London South East and some of the regional issues we're seeing. I do quite a lot of work in the real estate sector, and also do quite a lot with kind of property-backed businesses, so care and leisure in particular.
Right, thank you, everyone. All right, let's get into our first set of questions, which look at the sort of macro level. And let's start with you, Phil, actually. Despite what's happened with the mini budget, what was happening or is still happening at that high level with the economy?
Well, so when I started preparing for this webinar, it was just before the mini budget. So I've had to kind of rip up those notes and almost start again. As a firm, we continue to get asked, is a recession coming? You're likely to be becoming very busy. At the moment, it still seems to be almost like the calm before the storm, and we've almost kind of given up trying to call if there's going to be a recession. Saying that, we are starting to see some kind of more concerning stats coming into the environment. And a lot of this will be driven by that kind of market sentiment, which probably that mini budget really didn't help with. for someone who's just recently trying to remortgage, that's cost me a lot of money straight off. But I think there's a couple of key points I've seen. So if we look at, it's a very odd economy. So we've still got a very tight labour market, very low unemployment rates, which is driving kind of that wage inflation, which is not helping. If I look at some of the other cost inflation, I mean, on the real estate side of things, one of my bellwethers is always looking at the price of plasterboard. And that's seen kind of 20-25% increases all the time. And for me, that's a kind of usually a good sign, because that, it's a kind of core component of building construction, and can those costs be passed on? Other bits we're seeing with inflation, hopefully the interest rate rises will start to eat into that. The big question mark really is Ukraine and what's going to happen over the winter there. And that's something which, our government and any European government can't control. That's really going to be the difficulty. Turning to interest rates, saying, I think the latest projections after the last few weeks is still that by July 23, we'll be looking around about a 5.5% base rate. Now, that is something which, a lot of consumers in particular, haven't been used to. Seeing mortgage rates then going up to 8 to 9% potentially. That will be the big driver, that hit on consumer spend. One of the things that's probably protected us so far is over COVID, there was a huge increase in consumer savings. So rather than spending the money, it was being saved. The general view on that is we are coming towards the end of that, and those excess savings in the economy are now being spent. Which then really turns on to the issues about energy. That is one of the main issues I'm seeing, particularly in the leisure sector. For those businesses coming out of their fixed deals, really struggling. I'm dealing with a pub chain at the moment, and the increase in utility costs is equivalent to about a day to a day and a half of their trade. So, huge increases, and that is only been partially mitigated by government action to date. That is really going to be one of the drivers. But, it's not all doom and gloom. We're still seeing a lot of money and a lot of capital waiting to be deployed. And, issues like this, when you've got developers, construction firms getting into difficulties, provides opportunities for those who are well resourced to be able to move. And, and obviously, hopefully that will reprice some elements of the market to make them more attractive. It's quite interesting. One of the other bits I kind of get asked is really around, what else should the government be doing at this time? And rather than put myself on a soapbox for that, I would really say that some of the staff supply issues and labour issues still need to be resolved. It was supposed to be one of the dividends from Brexit that, we'd be able to free and choose to pick, people who want to come into the country to work. That clearly hasn't worked quite well at the moment. Supply chain issues, again, a lot more work to make it easier to do business, particularly to export. And on a smaller level, if finance starts to dry up into sectors, particularly SME level, whether there's more of a role for the British Business Bank in particular to help access to funds to keep things moving, because that is the main issue. Is once funding starts to dry up, then everything stops working. And then from my last point on that is really kind of rates and planning reform, which we probably do a whole seminar on directly. But, that is key. That needs to be changed. And they've pushed that back far too long, and that needs to be done. And maybe this current environment provides an opportunity to do so.
Mm-hmm. Lavinda, where you are in the sort of your regional view, I'm guessing you're going to echo much of what Phil has said, but is there anything you can add as to what you're saying?
Yes, absolutely. Just picking up on some of the things that Phil was saying in terms of staff shortages and expertise, certainly also in the hospitality sector and also in the care sector, we're seeing quite a lot of shortage of staff, and people are basically crying out for those. Also skills. The CEO of Waits was saying yesterday that he had a number of opportunities for people, but wasn't getting the skill sets, and was sort of calling upon the government to have some sort of immigration policy that allowed those skill sets to come in. Interestingly, Liz Truss picked up on that in her speech yesterday and was saying that they are looking at that, focusing on that. The other area is obviously the weak pound at the moment against the dollar, and that is costing businesses quite a lot of money. It's stabilised after the announcement and the U-turn yesterday. However, I think HSBC and other people are forecasting it's going to be about $1.08, which is still below what was happening pre-mini budget. However, again, U-turn this morning, so that may change again once the Chancellor has made his the plans for his growth plan known sooner rather than later. That may help stabilise the market. And so just conscious of time, but in terms of how the government can actually help, well, number one is building confidence, and hopefully the bringing forward of the announcements builds confidence. There is the issue around planning that Phil has touched on, particularly in the domestic house building, a lot of obstructions there. Also, lack of investment. I mean, De Vere again this morning or yesterday were saying that they are stopping investment into the residential housing market. That may have a knock-on effect. And basically, they're saying we're going to wait and see. Hopefully, they won't have to wait as long as we initially thought they would have to wait and see. So that may help. Education and skills, that's linked to the skills shortage, but rather than immigration, what is the government doing? This is part of their growth plan that obviously they haven't yet announced. And then finally is benefits, or whether the government is going to put a freeze on benefits or increase benefits. So they're coming under a lot of pressure at the moment. Phil talked about the energy, the fuel crisis. The government has put a cap on that, but is that being taken away if benefits are A, not increased with the inflation, or B, just basically even reduced with certain policies coming in where people have to find more hours of work in order to get benefits. So I think there's a lot of things to talk about. We could probably talk about it for the whole hour, but I think they're the headlines.
Okay. Well, thank you both very much. I mean, that's a good segue in terms of the pressures on residential development, which is something we're definitely seeing, and we'll get into very shortly. Fergus, do you want to say anything about how some of this is filtering just generally into the property market, maybe with yields or anything, or is it too soon to say?
Well, I think the valuers are being asked to opine on a weekly basis, which is perhaps always a sign that there's some significant market movement. But just in terms of the wider market, I think this is coming when we've got offices with an all-time low occupation. It's coming when we've got retail still struggling, through a sort of a seismic change in how people purchase. But it's also coming at a time when industrial yields and industrial and logistics trading is at an all-time high. However, over the last month, we've seen 50 to 60 basis points taken off those industrial yields, which is a huge shift on what's been the most highly prized UK assets. But then we can move on to what are people going to be doing, and are there opportunities there? So of course there are. There's going to be a flight to quality, and if we go back to where the valuers are opining their yields, everything has moved out apart from two of their subgroups, which we can see West End office and West End retail, and those are assets that are typically owned by overseas investors as their trophy buildings. So this then begs the question, does the weak pound make us a perfect place, and should we be expecting huge amounts of inward investment? I think this comes back to Avinder's point that it's stability that's required, and perhaps right now, if you're betting on just the weak pound, it's a one-way bet, because you don't quite know where we're going to be and what your exit looks like. So I think it's not as easy to say that we can expect huge amounts of investment from overseas right now, because there's more to provide the investment background than just the price of the pound. Also, when you start looking at sectors, it's interesting that the residential sector has been the the least written down. And that's because everyone's expecting inflation to occur, and the market seems to consider that residential rental property is relatively inflation hedged, in as much as when people's purchasing power is reduced, they can't afford to buy, so instead they go into rent, and therefore you get rental demand and you get rental growth. And we're seeing that certainly in the southeast so far, and I'm sure that will be spreading. So I think whilst developers are going to have enormous problems pricing their builds and developing units, actually once they're up and running and purchased, the rental story is good, certainly in the short term. Then we can start, where else are people still looking to invest? Well, the alternative sectors are still there. Student and senior living is still in demand. Interestingly, they're businesses that don't have huge operating costs. They don't have as many employees as your hotel sectors. So that kind of works. Also, they're very young trading classes. So every single year, every single quarterly rental income just builds a bigger picture, and people can get more comfortable with what they're actually purchasing. So to sort of sum up my little bit here, I think investors will be looking for synergies and opportunities, and of course there will be opportunities, because there will be sectors that struggle, and perhaps there'll be some repurposing going on. But I think in general, investors will be trying to keep whatever powder they've got dry to take advantage of what comes down the track.
Okay, thank you very much, Fergus. I think where we are on timing, I'll turn to you, Tom, in a minute to focus on development. But I think this is probably a good opportunity now to bring in our first poll, which is about interest rates. So where do you think the level will be in the next 12 months? I mean, we just heard, and it's well documented, where we might be by spring. So in line with predictions, I think. I mean, we've given a slightly longer timeline of 12 months, but yeah, based on what we're hearing, that seems pretty in line with what we're expecting. And then we've got our second poll as well, about what we think will be the biggest threat to the property market in the next 6 to 12 months. So the issues that were, as I said, persisting, interest rates and the energy crisis and inflation, obviously still very strong there. Interesting that only 7% think Trussonomics will interfere based on the last couple of weeks, but maybe they're confident that we will either get the numbers or there'll be enough U-turns that will assist with that. Okay, so now we're turning our focus to development. And Tom, what pressures are developers facing currently and likely to face in the coming months that you're seeing?
We've obviously heard from the panelists a lot of the macro information, and it's interesting, those polls as well. There's a bit of a spread of how people view what's going to happen, whether it's interest rates, inflation, and what's the biggest factor. And there's a bit of a spread there. But the biggest impact in all of that is uncertainty. And so what uncertainty is doing on can't fix down construction costs, can't fix down our interest rates. And if we can fix them, they're much, much higher than we thought they would be. So this kind of very fast moving uncertainty in the market is making transactions move a lot slower, as lenders, developers are kind of reassessing each opportunity they're looking at. There's obviously a medium to long-term view that real estate is the sector we want to be, and we want to be doing development, etc. But this short-term impact is really impacting kind of moving transactions along at pace. And we're seeing that with a lot of the developers we're working with at the moment, where they really want to develop out a site. They're really invested in the project emotionally as much as financially. But trying to fix down these costs is a real problem. And just also worth kind of touching on the lenders as well. The lenders' cost of capital is increased significantly. Obviously, it's all relatively linked to base rate. And whereas before we would see 80 to 90% of lenders have a very competitive fixed rate. At the moment, the fixed rate deals are not particularly attractive to developers, but they also want fixed rates because they don't want the variability, they don't want the uncertainty. So it's just taking a bit more time to settle at the moment on where deals are heading.
Are you seeing also, as part of that repricing the level of LTV, gross development values and things like that, the exposure that lenders are willing to take?
Yeah, I mean, absolutely. Lenders are assessing their cost of capital and their risk appetite, and that goes across loan to values, but it also goes across sectors as well. Whereas they might have been at reasonable LTVs on retail, maybe they're not even doing retail anymore. And it's all, I think it kind of comes back to that short-term view and that uncertainty, because they don't want to be the person that's lent on a deal that's, all of a sudden 6 months, we can kind of see all this coming, and we lent on a deal today that, obviously you should have seen that coming. So there's just a bit of hesitation. Whereas I think some of the panel have even said it, actually there's underlying, there's some good economics around these deals. Supply and demand dynamics, especially in residential, still exist. So those deals are still good deals. It's just it's a bit stickier to get transactions moving.
Right. And one of the things that I think, Fergus, you touched upon at the start was sort of valuations and the exit values. What do you think on these developments? What should people be expecting to happen?
I think it's a challenge. I don't think anyone quite knows the answer. I think I spoke to Moody's last week in preparation for this, and they said they're expecting residential values across the UK, obviously varying by location, to be moving out between 5 and 15%. But I'm never quite convinced by residential values falling in reality. I think we're more likely stagflation, where perhaps things just don't move as much as they would normally, and that was played out. So in the global financial crisis, we saw huge drops in values of flats in London. In houses, we saw stagflation, but those flats then came back after the recovery stronger than they would have been, stronger than their stagflated position. There was the implicit growth that would have been there during that time was then seen on these flats. So investors did extremely well out of that, which perhaps there is opportunity there for people. But I think if you were to be forecasting exit values at the moment, you're a pretty brave man, because it's incredibly difficult to know what the impact of, if we have, as that poll suggests, 5% inflation, 5% interest rates plus base. That's going to be an enormous challenge for huge numbers of people. Quarterly, there's roughly around 300,000 people remortgaging their properties in the UK at any one time. And that's a lot of people who, for the next few quarters, are going to be really struggling. And there's bound to be an impact in pricing if they can't buy, or perhaps they become a forced seller. I think it's too early to tell. And Phil, as Phil said earlier on, we're playing the waiting game. And I think until we see the impact of those 300,000 people not being able to, or a percentage of them not being able to remortgage, we won't quite know which way this is still going.
Okay, well, going back to you, Tom, then, I mean, as you advise developers and lenders on each side of these kind of deals, what are the options to try and ease some of these pressures as we get a bit more movement, understanding of where the direction of travel is going? Like, you have to actively manage your position as a developer, or even a lender, I suppose, potentially through the next months.
Yeah, I mean, I think the key thing really is that developers being aware of the issues that are at hand and not putting your head in the sand. It's really important that you have your team of advisors around you that are advising on the issues, and especially when you're dealing with a lender. Typically the lender wants to work with you if there are issues, whether costs have gone up or you're under pressure on your loan to value metrics. They want to work with developers. They need to kind of assess their own risk. And I think sometimes we see that developers kind of go to ground a little bit, they just go quiet, hoping that it will resolve itself, when actually there are ways you can kind of alleviate some of these pressures by working with the lender. Now, obviously, the obvious point would be, that there is funds available in the market to kind of help these schemes move along. And when there's funding shortfalls, we know there's still a huge wall of capital out there. So that's obviously a positive. But yeah, we would definitely kind of major on getting that advice earlier and working with a lender rather than trying to work against them. especially on some of the minor points. We find that a lot, where sometimes on smaller issues can become much bigger issues by kind of arguing the point rather than kind of focusing on what the big key issues and a bit of a strategy deal with a lender. And that's where I think there's a lot of value in the market.
And Phil, I think we were talking about this before. Someone who operates at the sharp end when things are going wrong or have gone wrong, what do you think are the sort of takeaways for a developer to bear in mind?
Yeah, I mean, I mirror Tom's comment, being proactive. Human nature, when you get into a stressful situation, you either kind of fight or flee. So either they ignore the situation until it's too late, or they're very aggressive to the lender. It's all going fine, leave me alone, I know what I'm doing. That early dialogue is key. What I'm seeing at the moment is on some of our developer clients is obviously they're getting that price pressure from their contractors, and they need additional funding. Now, the banks I'm dealing with will look at that sensibly. If it's effectively that's the only way we can get the site finished, there needs some flexibility there. What we find sometimes is those developers will just assume the answer's no before they've even asked. And that really causes the issues. And the earlier you can deal with the problem, the easier it is. What I hate is when I get a call saying they've asked, to pay the wages on Friday and there's no money, and there's an immediate request to the lender for an advance for wages. That we're good, but we're not. There's limited things we can do in that situation. But that key bit really, it's being attuned, making sure you've got the information ready, and therefore you can make a sensible proposal. And that's really is the key. I know it's easy for me to say, and it's harder when there are people in the trenches doing it, but they shouldn't avoid the issue. Most of the problems we see is where people have hidden those issues until it's too late. Avinda, does that kind of tally with your experience as well?
Yes, absolutely. It is all about communication. Lenders aren't always the monsters that they're sometimes made out to be. A sensible proposal, because ultimately it's probably in most cases in the best interest of the lender to work with a developer or a project, because that's the way in which they're going to get paid out, because otherwise the value of the asset is going to be dramatically reduced, and that's not in the best interest of either party. So absolutely communication, facing reality, and coming up with a plan, whether that's with us or internally. Sometimes it does help to have a outside opinion, just because you get a fresh pair of eyes, and you sometimes directors do have a tendency to have a sort of a rainbow effect, and it's all going to be okay, just because they've not actually looked at the hard figures, and because they're entrepreneurs rather than FDs, and that gap can sometimes cause an issue.
Right. Yeah, and this is
just the other thing I'd add to that is that all of those things add to the credibility of the developer. So if they are taking on those issues with a lender, being a bit more open, then typically a lender's a lot more amenable, because they're like, well, this person's a credible person, they're kind of taking the issues on, we want to work with them. And then that typically, if the project ends up kind of the lender gets repaid, really leads to repeat business, and because that lender wants to work with that type of developer. It's when there's kind of a very closed world view, then that's where you kind of get into very kind of adversarial positions.
Well, it's probably a good. Sorry, go on, James. Have we got a question?
I was just going to say that we have a question around how you square the circle on development in this environment. So I suppose to summarise, you've got you've got an increase in costs. The pound going down, imports going up. It's very hard to find people, so you have to pay them more. And at the same time, you've got a squeeze of 5 to 15%, according to Moody's. Thanks for that, Fergus. So within the overall budget, what has to move so the developments can continue? And the suggestion here is that it has to be land values, but it would be good to hear from the panel, what you feel would unlock things going forward.
Fergus, do you want to take that?
I think James, you have summed it up. The only bit that can move is land value. Unfortunately, for the land value to move, you've got to have a seller that wants to sell. So perhaps this could actually be answered by, what are the opportunities that might arise throughout all of this? And actually that could be that there will be repurposing of development sites. So for example, you might have a hotel that goes into administration, and perhaps you could get a change of use on that and turn that and convert that into flats, but you might be able to buy that at a price that makes sense on a development appraisal today, as opposed to trying to buy land that has been marketed with consent for the past year or so, with a landowner who's fixated on a certain price per plot. So it is in the development appraisal, it's the only flexible bit, or it's the most flexible bit. But you've got to have a seller who wants to sell. So it's a challenge.
It is, and could you elaborate on seller who wants to sell? Because I suppose the temptation would be to sit on the land right now and wait for things to get better.
100%. 100%. Why? If you're a farmer who had gone through a very, very long process of promoting a site through planning, with Phil's alluded to the length of time planning can take. He's promoted this site. He's got it zoned for residential. It's got it in a master plan. He's worked out how he's going to parcel it all up to sell to either a third party who's going to service the site, and with the idea of then selling down plots to developers. Why would he do that today? He's been much better just to wait another 5 years. It's probably already taken him 20 years to get to this point. There's no advantage in him bringing that to market right now.
What that might do to the market is, if there's less development happening, is that obviously then there's less product coming to market, and there's a lag effect. Obviously we're all quite short-term focused at the moment because of the issues that are kind of quite seriously going on at the moment. But ultimately, if development doesn't happen for those reasons that Fergus was setting out, then in 18 months to 2 years, there's less product coming to market, which then obviously supply demand, less supply, but there's still a demand there. So does that then have an impact on pricing at the back end?
Yeah.
Right. Well, thank you. That was really good coverage there, I think, on that topic of development. And it's probably a good time to bring in the poll, our next poll, about development going wrong. Something that we've alluded to, and we're interested to see what people think is the primary reason in their experience, or what they fear, I suppose, most, of being the thing that might bring a development down. No real surprises there, I guess, given the state of things. Well, thank you, everyone. We'll move on to our next section, which is to focus.
May I stop you there, Alex? Apologies for talking over you, but there's a question come in that relates essentially to the previous discussion about distress in the development market. And the question really is, how much distress does the panel think that there is going to be in the market, and what level of repossessions might there be? Or do we think that the developers will be canny enough to hold on and steer through the choppy waters?
If I can answer that, back in 2008, when we had the financial crisis there, the repossession figures went through the roof, and there were a lot of development sites being repossessed. I think this time round, it's not going to be as dramatic. I think what you're going to be seeing is people working together, and that includes the lenders together with the developers to maximise, as I said earlier, the asset. There's also going to be, I think, some government help over the next few weeks regarding investment zones and planning, which is going to be more local. I think probably Fergus and Thomas can comment on that a little bit more. So I do think that there is going to be, but that I think maybe in smaller developments rather than the larger developments. So that's my opinion. Phil, do you?
Yeah, I kind of mirror that. The bit I've been seeing is actually that contamination risk of developers, very low margins, issue on one site, and then that domino effect. So the last few things I've been looking at have been that, where you've got some decent sites being dragged down by the underperforming one.
Mm.
But again, when you look back at the last financial crisis to now, the sources of funding in the market are so much more varied and deep. And really, a receivership administration is the last route because the damage to value. So I think there will be more opportunities for things to be kind of kept alive rather than going through a formal insolvency, with the hit being taken but not being so public.
I think the issue may be that some of the larger lenders haven't got the workout teams that they had pre-2008, and I think that they will be one would hope there's some significant recruitment going on in that part, because if we are going to be keeping things alive, the banks really need to be on these cases, which sometimes we've seen that they don't quite have as much as a hands-on approach as they need to.
I think actually that might not happen. I think actually those major lenders will just sell those debts on to others to deal with, which creates opportunities, but also means that the borrower could find themselves in front of a very aggressive lender from what they started with.
Yeah.
So that's the issue.
Yeah, I agree with that. I think after the last crisis, I think lenders will be much more careful about the type of development loans that they've been giving. And I think the loan to values have certainly shrunk. Whereas in prior to 2008, we were seeing, loan to values of 95, 100%, sometimes even more. We haven't seen that since 2008 and 2009. The mainstream lenders being much more conservative, but then picking up on what Phil's been saying, there's been a lot of secondary lenders out there who are a lot more aggressive, whose interest rates were particularly high anyway, prior to the current interest rate increase. Even prior to this mini budget, there was very, very high interest rates. So I think it does depend very much on the lender and the aggressiveness that lender particularly takes. Certainly, I've been seeing in a number of receiverships that I've been doing over the last 24 months have been coming from secondary lenders rather than the mainstream lenders.
I think the other
just worth noting that secondary lending market since 2008 has grown significantly. It's a much bigger market that hasn't necessarily seen this change in the market, especially this quick change, and whether those lenders are kind of geared up, like Fergus says, to actually deal with a bit of distress in the market. Now, maybe they will sell off some of their loans, but not all of them will, and not all of them will have that skill set internally. So, as much as what I said earlier, that developers might put their head in the sand, lenders might do the same as well on their own loan book.
I think the other interesting thing to note is that if we mark to market these loans, if you're underwriting, as the funds have to do on normally a quarterly basis, but currently a weekly basis, if lenders were doing the same on their development sites, I think today LTVs that were looking very comfortable at 60% probably would be nowhere near that. I think lenders have to be realistic and look at the term of the loan, look at where they think their exit's going to be, and you have confidence in the borrower. And I think we'll probably come on to this when we start talking about receivership insolvency tools. But you have a lender having confidence in the borrower to do what he's meant to do, and to engage with them when he's meant to engage, and to perform well is the most important part of this whole cycle.
Thank you. Well, we'll move on.
I'm sorry I keep saying this to you, Alex, but we've clearly found a rich theme here. But we have a question from one of the audience members to really for Phil to explain in a bit more detail what the difference is from a lender's perspective in going for a receivership versus selling the loan to those aggressive debt funds you were talking about.
I suppose the key issue for most lenders is certainty of outcome. So direct selling the debt at least gives them a definite loss, shall we say, against the risk of working out to hopefully a potentially better outcome. So that is the real nub, and it really depends on the appetite of the lender and their experiences. So a lot of our work recently has been that kind of hand holding through, and sometimes we will make that recommendation. But it comes back to kind of Tom's point earlier on. It's the trust in your borrower client. If you've got a working relationship and trust, you're more likely to want to work it out. If you've lost that trust, or you're just finding you can't work together anymore, then selling it on to someone else to deal with becomes more attractive.
Yeah, also, if I could pick on that, if you're selling onto somebody else, you can also have some form of overage clause, or a way of sort of reclaiming something once the debt has been, the property has been built out. Whereas in a receivership, what normally happens is a receiver gets appointed and there's an agreed plan with the lender to exit. So that may be by way of auction, or it may be by way of private treaty. In that case, it's unlikely that, well, certainly not in an auction process, but it's unlikely that you can claw anything back once the development has actually been built out. Whereas, as I said, if you are selling it, you could try to negotiate some sort of overage clause or some sort of payback once the development has been built out. It depends how quickly a lender wants their money back, because a receivership is a much smarter, quicker tool to get the lender's money back by way of auction or sale. Whereas if you're selling it and you're selling it for, say, £1 or something like that on day one with the overage clause, later on you could be waiting 5 to 10 years or however long that development takes.
Okay, thank you. We will get on to receivership insolvency tools shortly. I'm conscious of the time, and one other thing we wanted to pick up, although we've touched upon it was other property sectors. And so, Phil, I wanted to raise with you a sort of overview of the other sectors that suppose are at risk. Suppose we're talking operational sectors that the cost of doing business is a real hampering effect on them.
Yeah, certainly. So if we start with retail, I mean, it's been a relatively benign environment for most retailers until recently. There was effectively the spending bounce coming out of COVID. Obviously, a lot of stock being held at lower prices, then being sold at higher, so some profits. What we've seen actually in the last few months is we're dealing with a homewares business at the moment, quite a well-known established homewares business. Its sales literally fell off a cliff in August, which, you know, historically for long that was unheard of, and just shows some of those pressures coming in, particularly around consumer sentiment. Luckily, most retailers have already bought and locked in their prices for effectively their Q4 trade. So the recent movements in the exchange rate, hopefully most would have been insulated by. They'd already fixed and hedged for what they needed. I think probably January time would be interesting to see actually who the winners and losers are, and that might force further restructurings. So at the moment, we're not seeing a huge amount in that, but we're expecting the pressures to start coming in, particularly if consumer sentiment turns. Leisure is, as I alluded to earlier, huge cost issues on them, huge staffing issues, really causing the problems. Some of the restaurant clients I'm looking at the moment, you know, they're having to run limited covers because they haven't got the staff. So when you've got a high fixed cost business, that really eats into your profits if you just can't service the demand that you can get. Those ones are really kind of causing us issues. I'd say then really does come down to kind of the brand and the position of them. What we normally find in recession is the top end ones still work. There's money and people will still spend there. The lower end propositions still work. It's the bit in the middle that gets squeezed, and that's typically where we see the pressures. So it's interesting. I was out with a lender this week who wanted us, as a matter of urgency, to come in and start giving some training to their teams, particularly around their investment lending portfolio, because they're particularly concerned about what's going to happen with their tenants. So that kind of gives a picture of, you know, they called that and even paid for my breakfast. They must have been keen for the advice. So that bit's going for the other bit really is it's just the kind of debt bubble that's built up. The government lending, which is guaranteed, when you have to try and refinance that, it's very difficult to reduce these options. And there's a huge amount of HMRC debt built up. So that again limits options to get additional funding in. Avinda, do you want to cover kind of care and the kind of industrial side a little bit?
Yeah, absolutely. Sorry, just quickly going back to the retail sector, we've seen a lot of the larger units being actually converted into flats as well, into residential. I mean, John Lewis have been one of the people who've been driving that forward. So that'll be interesting to see how they will continue with that under the current climate. In terms of care, absolutely. We've seen locally, certainly in the Midlands, a lot of care businesses for the reasons we've discussed before, which is lack of staff, also government funding. But it's been the smaller care homes rather than the larger care homes. So there's sort of under 20 to 25 bed type care homes that are struggling in the main. We've also touched on briefly, I touched on earlier, was construction, where you've got the development sites not continuing because of lack of staff and the cost of supplies. The other area is where potentially things could get better is, and again, I think Fergus touched on this, is the foreign investment with the weak pound. But again, because of the stability, we might not see that sooner rather, we'll see that later rather than sooner. So they're the sort of the 2 or 3 areas that I would suggest may struggle in the next 12 months.
Okay, great. And I'll bring you in, Tom, just to talk maybe a little bit about the opportunities, and then we'll turn to you, Fergus, about focusing on the receivership and the insolvency tools. So based on what we just heard from Phil and Avinder, what are you looking at with your clients, or in terms of those investment type sectors, those operational sectors? That
Yeah, I think opportunities still exist. There's, if you look at how investors are investing across different asset classes, real estate is still seen as a key sector they want to invest in, deploy capital in, and be exposed to. So that is driving kind of people to say, have you got any opportunities? Quite often, it might be that their return parameters are changing, which is then making it a bit of a struggle on some deals. But ultimately, we've seen that over many, many years, actually, in terms of the weight of capital that wants to come into the sector in the UK real estate market. In terms of specific opportunities, we're seeing sites that are maybe kind of part complete, and specialist developers who have got a specific skill set to step into those situations, which is really, really attractive for maybe a lender or an investor that has kind of been left with a site where the contractor might have gone into administration, and the developer unfortunately gone bust, and maybe that situation, which is really complicated. There are certain developers out there that can really take those forwards, and there's that potentially could happen a little bit more and be further opportunities in that way. I suppose finally, I think Fergus mentioned this earlier around the consolidation in the market. I think we will see that as an opportunity where medium-sized developers maybe kind of team up, and there's a more consolidation in the market, and that's another way investors can kind of see a value add by bringing 2 or 3 different companies together and consolidating the market.
Okay, great. Well, before I bring you in, Fergus, to deal with our final section, we have got a poll about what we think might be the vulnerable sectors that either create opportunities or just ones to watch. I suppose with recession on the way and people not having as much in their pocket, that may make sense. All right, so we're moving on to our last section. I'm conscious we've got running down the clock slightly, but Fergus, I'd like to bring you in. We've already touched upon it earlier, kind of distinctions, or partly the distinctions between administrators and receivers, who are going to be the main workout professionals that might be involved. From your perspective, what is your approach? What are the differences for you as a receiver when you're appointed by a lender? I think
receivers are the most simple tool to execute a distressed position with a fixed charge. They work best with a single asset. And Phil and Avinder will go in detail all the reasons why administration can assist you further when that's not the case. But receivers it's a very straightforward process. It doesn't need to go to court. It can be quick and easy. I'm a real estate professional acting as a receiver, which means that we we have the real estate skills to deal with problems, which can be very useful. But as I set out at the very beginning, we also stand beside administrators who act as receivers to offer the same services. So I don't think it really matters who the receiver is, but I think having property people involved can be very useful, just to fully understand where the process and where the value sits. Receivers can collect rent, they can develop up to a point, and then they can sell assets. So it's a straightforward process to get receive monies back to a lender. I think the most important piece of this is receivers can get as much information as they need to get to be able to sell something to boost a value, and receivers' powers are actually quite limited. So if you're using receivers, you as the lender need to be going and getting that information and demanding that from your borrower up front, because a receiver can't demand information, and that's where sometimes administrators are used to assist, or it's a case might switch from a receivership to an administration if any information isn't forthcoming. And we've certainly had that in the past, where we had a large industrial portfolio where we had no information on any tenants, we had no rent rolls, we had nothing at all, which was a bit of a surprise. Lender didn't have it, and we were appointed receivers and then said very, very quickly that we really shouldn't be here. You need an administrator to demand this information. But I've been a receiver of everything from effectively a garden shed to very large industrial portfolios of several hundred million. So it's a very powerful tool, and can be utilised by lenders on a quick and easy, cost-effective basis. But it has its shortfalls and shortcomings. And Arvinda, I think you're going to tell us what they are.
Absolutely. I absolutely agree with what you're saying in terms of the receivership process is the very simple process, in the sense that it's not a court process. It's a process where the lender invites a receiver to take an appointment. In terms of the receiver's powers, as you say, they are very limited if you're appointed under the Law of Property Act, which is basically to insure, to sell, and to collect the rent. So it's very important where lenders have got a property which is perhaps having a trading business, for example, a care home, that their charge actually covers the ability for a receiver to trade. I've had a number of incidences where we've been appointed as receivers, and when you actually look at the charge document, actually you can't trade. Or in one circumstances, I was allowed to trade, but I wasn't actually allowed to utilise the chattels within the property, so which restricted me again. So it is a very good tool. It's a very good tool where you've got a property that's either a residential property or a commercial property that's been rented out that you want to sell very quickly. So that's where I would suggest that a receivership is the correct tool. The other good thing about receivership, it creates a barrier between the lender and the borrower. So even though, the receiver stands in the middle and has an agency agreement with both the borrower and the lender, unless the borrower is insolvent. Won't go into that. So it creates this barrier, which basically means if anybody's going to get sued, it's going to be the receiver and not the lender. So that's always a positive sign. Going back to what Fergus was saying, that's normally, and in most cases, where a lender of a development site or a property asset has a fixed charge. Now, if a lender has a fixed and floating charge, then they have the ability to appoint an administrator. Now, the administrator wears a slightly different hat, in the sense that the administrator has a duty, first of all, to all creditors, but also has the ability to realise all of the assets in a company. Now, that might be attractive to somebody if they think that they will not be repaid their loan from the property asset, so on the bit that falls under their fixed charge. If there are floating charge assets, the lender with the fixed and floating charge will also get some repayment from the floating charge element. So that's where it is more attractive. But when I am advising anybody, and it is a property lend, I do always suggest that it's more, it efficient to go down the receivership route. And Fergus, I do pick up on your points about sometimes not getting the information and certainly not having the powers that you would have as an administrator, as a receiver. But to date, I think Phil will agree with me that we do manage to get the information. That can be a number of ways, in the sense that you will try and obviously, first of all, work with the borrower. If not, you try and source information from elsewhere. So it is always much more efficient to go down the receivership route rather than the administration route. Other than, I would say that, as I said, if the lender isn't going to be repaid from the fixed charge, then absolutely the floating charge. But an administration is a court process. So it is a lot more costly, and a lot more elements are into play.
Okay, thank you very much, Avinda. That was a brilliant sort of whistle stop tour through that those differences. I'm conscious we're at 10 o'clock. There was a final question, which I think I'm going to put out anyway, because it's quite an interesting one. I think that it will pull together some of the things we've already mentioned, and then we can kind of finish up, which is, I'll direct it to you, Phil, which is, how do you approach buying a distressed asset? We've kind of mentioned opportunities and the like. So if someone's coming in, how they should approach someone like you.
Yeah, well, certainly. So when I've got my hat on as an administrator or receiver, and obviously marketing a property or an asset, obviously we get quite a lot of interest normally. So the key is, how do you get yourself to the front of that queue to get my attention? And it's not just simply price. I don't have to look at the best offer. I can take the one I feel is most capable of being concluded. So really, credibility is a key here. So I'm more likely to do a deal with a team which has got the track history, the right advisors, legal and professional around them. All of that gives me confidence that that party can contract quickly and with certainty. So I'm not going to get a lawyer who doesn't know how to deal with an administrator or receiver, because that just adds a lot of issues. I've got agents around who will know how to put the offer to me and what structure I need to see around it. And hopefully one where they can clearly show how that funding is going to be paid and met. So if I have all of that, it helps you get to the top of the queue to talk to me, really. And that really comes back to that. So, if you turn up, you've got a Fergus and a Tom beside you, I'm going to be quite worried that I'm going to be stitched up, but I probably will talk to them a lot more. So.
No, I think that's right. I think that goes back to our sort of message throughout, which is getting that advice early, getting the right team together. And that's what today's all about, showcasing what we have to say as a group around this panel. So I thank you very much for that. Conscious we run over slightly, and there's 2 polls that we would love to take with the audience to gain an idea of people's sentiments. So first one is about future workload. No, yeah, about the same, a bit busier. We're good. Hopefully. And then the last question about what people might be working on. Appreciate we've got a mix of different audience members, but here's the selection again, that same period. What do you think you'll most be doing? That's great. Pleased to see that top one. Interesting. Enforcement recovery is definitely bottom of the list at the moment, which maybe echoes what we've been saying about collaborative approach and working out positions. Well, all that's left for me to say then, thank you. Sorry we've overrun a little bit, but appreciate everyone's time, and thank you to the panelists. And yeah, thank you again for your time.
Thanks, Alex.
Thanks a lot.
Thank you.